You ready to lock in, my boy?
I'm ready.
You sure?
Yep.
All right. Why do they make investing so confusing? Is that by design? You used to be a financial advisor. Did you used to talk with big words on purpose?
I did, but it wasn't not on purpose. I spoke in big words, and then I realized what I was doing, and then I would try to scale it back.
Okay, so let's start with this. Why is investing as complicated as people make it out to be? Let's start there, because it might be.
Some investing is wildly complicated. It's not investing that everybody should be participating in, though.
What type of?
Meaning you can invest in things that are a lot simpler, but you're getting enticed to participate in things that are more complicated, and then you're being told you really need somebody to do this for you.
Okay, so if I'm hearing this right, you would say that people talk about the complex strategies, but then if you look at what people are actually investing into, it's indexes, mutual funds, very basic. Is that what I'm hearing?
It can't be, but let me give you an example. I would have people come up to me and say, hey, I was told by a friend of mine that you should really be investing in options for me. Like, how do we do that?
Ah.
Yeah.
Okay,
and then I would say, well, do you know what options are? And they would say, no. And I'd say, well, that's why we're not doing it.
Oh, okay. So if I'm a client of yours in the past, and I'm like, I want to do some options. I want some leverage.
I didn't do that in my practice.
You did.
Doesn't mean that it's wrong.
You just said no.
It just wasn't a part of my business.
Okay, so you just
There are financial advisors or stock pickers that will do that on behalf of people, though. But I wouldn't do that with somebody if I didn't have a baseline understanding of what it is that they were doing.
Okay, so can we start there?
Sure.
What's an option? Why are options complicated, or is that there's risk tied to it?
Well, you are effectively with options making a decision on what you think a future outcome will be for the underlying investment that you're making. So I will try to speak in layman's terms, so you're going to have to call me out on this, right?
Okay.
Because I might go back into the world of financial advisor. But let's say that, let's not use stocks as an option. Let's say a house.
Okay.
Let's say you had a house and you were going to sell me the house, or you had it on the market. And I came to you and I said, Mikey, I want to buy your house, but I don't want to buy it until 12 months from now. I will give you this price, which will be like our future price, our execution price, and I will pay a fee in order to get you enticed enough to hold it for me for a year so you don't sell it to somebody else. That's an option. I'm purchasing an option to execute on the purchase at a future time and date. Now, the risk for both of us is price movement.
Okay.
If the price goes up and we locked in, let's say we locked in a price at $1 million. 12 months from now, the market goes through the roof, and now the value of your house is $1.5 million.
You still get it for $1 million.
I get it for $1 million. I win.
Okay.
If the price, however, goes down, let's say it goes from $1 million, the value goes to $700,000.
What happens there?
I could say, you know what, I chose not to buy it.
So I hold my asset and I keep your fee.
Correct. You hold the asset and you keep the, let's say, deposit that I put. So stock options, same concept, right? It's I am trying to lock in a future price, or I'm locking in a price today on where I think. So if I buy a call, which is the term of an option, I am buying a option to purchase a stock at a price point that I'm establishing today at some point down the road.
Okay.
So we both take risks, but you can have a big upswing. So you have call options and you have put options. And this is where it gets confusing, because you have two options, calls and puts, and you can buy a call or sell a call, and you can buy a put and sell a put. So you now have 4 iterations of decisions that have to go into it. How many people are going to be able to track that? We can all learn it. I learned it. I actually have already since kind of forgotten even some of the put side of these deals.
Okay, so how I'm hearing this. Okay, there's some complexity there, right? Because even as you were talking, I was like, but you don't have to be doing options. So so maybe this is what's happening. Financial advisors, the gurus online, Kramer, all these people, they'll talk about things like puts and calls, but most people don't have to do that in their investment strategy. So you just accept it. I'm not doing that.
Well,
Is that
I
what
guess,
you're saying?
yeah, but the question for you, I'll put back to, do you think most people should be doing it?
No.
You think most people should be staying away from it?
I do. I think there's a sliver of people that should, and those are going to be your savvy data-driven type of investors.
So what makes most people want to do it when you and I both know there are people that shouldn't be doing it? Because we know a lot of those people.
Yeah, we get excited by upside. Look, we're human.
Right.
We do struggle with greed, no matter what. That is a challenge we have. So when you hear about, I mean, this happened to me. I bumped into a friend years ago. I'm like, what's going on? How are you investing? What are you investing in? And, he started talking about options, levered up, and how he's making huge returns. When you hear about somebody making huge returns, you naturally go, oh, I want to make that. And so I think that's our risk, is just getting excited that we can make money. But what's interesting is the option that you just gave in real estate is actually something we do in our business. We put properties under contract, and that contract gives us an option to buy it in the future, and we have to pay for that option. And we do that so we can get properties entitled before we close.
We put money up front as our hard-earned money deposit, and hopefully it pans out the way we think. Because the reality is, for us in the real estate side, if we put, let's use an example of one of our properties. I won't specify which one it is, but we locked in a price on that property of $6.4 million.
Okay.
We went and got it entitled. It took us about a year and a half to get it entitled. That property, not entitled, is just what it currently is. Entitled to be what it is ultimately going to become is worth a lot more.
Right.
So we got it entitled. Now the value of that property was no longer $6.4 million. It was worth, we felt, 10.
Yeah, but we got to execute on closing at 6.4.
Correct. So that's why the options game for a lot of people is really enticing, because you can effectively set a price point where you're paying a little bit of money to lock it in. And if you're bullish that stock, let's say Tesla, is going to go way up in value, you're buying low and you're getting the reality of a higher price point down the road.
Yeah. So to really, pull it full circle, when we're doing real estate, we are putting that money at risk during the contract. Because if we don't get it entitled, then the money that we gave the owner to hold the contract is gone. So there is entitlement risk. The difference here, I think, and we talked about this last night, is controlling the asset or controlling the momentum. We are the ones that go through the process of trying to get it entitled. In the stock market, you're hands off in a lot of cases. So you're just making bets in some regard that whoever owns that company on the public market is actually going to drive the value up, right? So I don't like that side, but whatever. I understand it.
Well, so then who benefits by making investing in the financial market so complicated?
Any middleman, right? Wouldn't you say?
Mm-hmm.
Yeah, the more confusing it is, the more we go, I can't do this. Can you do it?
Yeah, because you want to participate in it, but you don't know how to participate in it. So you either get to one or two decisions. Either you're just going to say, I'm not going to do this, I'm hands off, or you find the person that you believe can do it on your behalf.
Yeah, and here's what I think is interesting, because does that mean that you shouldn't pay anyone as a middleman? No financial advisors, no bankers, no one on Wall Street, nothing.
I don't think that that's true. That's not what I'm saying at all.
Yeah, that's actually not what I'm saying either, because I do think there's a lot of value in having a set of eyes to run things by you during hard times. It's really about it's about downturns, right? When things are good, it's easy for us to make decisions. When things get hard, we naturally pull back and don't want to buy, and we get in this position of I need to sell before it gets worse. I think that's where it's really good to get guidance. But at the end of the day, could somebody manage their investments, investing in index funds themselves? Yes. I just think having guidance I think there's value there. Right?
The most valuable, the thing that I always felt when it came to investment management that I provided the most value for my clients for was in those times where I had to convince them to make a decision that they weren't naturally inclined to make.
So give me an example.
So, great example would be during COVID. I had a client who, when he came to me, had a ton of Facebook. I mean, I want to say that Facebook accounted for probably 60% of his total investment portfolio. Now, in 2019, Facebook at that time was doing really well. He was up pretty significantly, but the amount of money that he made in it represented now so much more of his portfolio than it did even before. And so what the conversation I had with him was like, hey, look, we should really consider selling some of this position off because you own way more than you should of one company. And what was his response? Absolutely not. I don't want to pay the taxes on this money, and Facebook is just going to keep going up because of the recent wave that he saw. All right, so had the conversation with multiple times, didn't want to listen to the advice, so be it. 2020 comes around, COVID hits, Facebook took, like most stocks did, a massive nosedive. Now he calls me in full-blown panic. We have to sell, we have to get out, and now I have to look at him and say, no. Now is not the time that we should be selling this position, because while you are down, you're not out. You haven't taken the L yet on your investment. So we need to now weather this storm, let it rebound, because at that time we were all kind of suspecting that we would see a V-shaped recovery from COVID, given that it was a black swan event. And so because of that thesis, the advice was, keep the position, let it rebound, but when it rebounds, let's have the conversation at that time to sell.
Right.
And don't talk to me about taxes.
Yep.
And he's like, okay, I got it. Fast forward 6 months, the rebound took place. I called him up and said, now's the time to sell. And what did he say to me?
Nope.
Hell no. I don't want to pay the taxes. It's going to keep going up. And it's almost like, am I not doing a good job in advising this guy?
Yeah.
Or are we so driven sometimes by riding the wave that even in the face of advice, we can't take it? And I ended up letting him go as a client because I couldn't take the risk of him coming back to me at some point in time in the future and saying, hey, you did not do a good job as my financial advisor. I gave you the advice. You chose not to execute upon it. And so the value of a financial advisor in very large part is to talk you off the ledge from making bad decisions in moments where your emotions are driving your decision making. When you are greedy and you think things are going to keep going up and you have too much of an allocation, actually, we should probably pause and say like what we mean by saying that. Let's say you had $1 million invested. And let's say you start off at $100,000 of your $1 million was in Facebook. And now $600,000 of your $1 million investment is in Facebook, right? We're keeping the $1 million stagnant. 10% of your total investments in Facebook versus 60% of your total investments in Facebook is a very different risk proposition, right? And Facebook is not the issue here. You can replace Facebook with any company. The point is you are over allocated in one company. You have too much of your money relying on one company performing. You shouldn't put yourself in that position. And so having a financial advisor walk you through these decisions of, hey, we're a little high, let's sell and go down a little bit, or we're a little low, now's an opportunity to buy so that we can participate in the upswing, that's where the value comes in. But you have to be willing to listen to that.
Ryan, did we understand that? Was that simple or was that complicated?
I understood it.
All right, here we go.
I just want to point out that Ryan told me before this podcast started that the advice I gave him on what to invest in has worked out really well for him. And then I said to him, well, I'm glad I could help. He's like, well, that's why I call you first for everything.
Okay, here we go. Let's bring a real life example, right? Because we did a podcast about how do you know how much to invest in your 401k and IRAs, and do you go beyond the matches? And I started getting a lot of questions about that. And here's one I got this morning. I have a 401k. I work at Amazon, and they match 50% on the first 4% of the employee's base contribution, resulting in a maximum company match of 2%, which throws me off. What should I be doing there? And then he followed it with, I want to do a Roth, which is $7,500 yearly limit. And also Amazon gives me stocks, which I have no idea what to do with besides let them sit.
Well, okay, so let's start with the last question. The stocks that Amazon gives him is probably tied to tenure.
Yep.
So he's got to work there. My assumption is he's got to work there for a certain period of time in order to be vested in that position.
Do you want that?
Well, if you intend on staying there, yeah, you want it. Those incentive plans could be very financially lucrative. But the company is not stupid. They're structuring it in a way that they keep you involved in the company in order to get that incentive. So they may dangle this carrot out for 3 or 6 years before you're actually vested in that stock. So if you intend on staying there, that could be very valuable for you. Now, the question on the 401k contribution, I would call your benefits department and say, I don't understand this percentage allocation, 4% up to 50% and then 2% beyond. And I would say, if I contribute $150 out of a paycheck, how much money are you going to match me?
Yep.
And let them give you numbers to numbers, because your salary is going to be also a factor in this. And then they will answer that question for you, and then you'll be able to make an educated decision. But again, what we talked about in that last podcast, I would put in whatever the company is willing to match. Because if I put in $150 and Amazon gives me $150, I just made 100% on my investment.
Yep.
On day one.
So everyone should be doing that.
Yes, but that tiered structure is an interesting one. I would call the benefits department and say, let me understand this in terms of numbers based on my salary. If I allocate $150, $200, $300, what is the match?
Yep. And then do that.
Yeah.
Okay. So what if investing isn't finance? What if investing is just ownership? What does that mean? What does that break down to?
I don't understand the question.
So a lot of times when we're talking about investing, I think finance comes into the equation, right? Stuff like leverage and derivatives and uncorrelated investments. And
so you're talking about take it to the most simplistic thing?
Yeah, because if we're really going to try to make investing simple, at the end of the day, is investing just ownership?
Depends. Are we talking about financial markets or real estate?
Well, let's go through all of them.
Okay.
Right? Because investing at the end of the day, and correct me if I'm wrong, is just owning productive assets. Correct?
Yeah, I'm thinking of owning the term owning differently than you are.
Well, could you take it a step? Can you take it? Could we?
I would say participating in productive assets. Because, and I'll tell you why, and I'll answer the question for you. Let's talk about financial markets. You have equities and you have fixed income.
Okay, but
and those are the terms that a lot of people are like, what is that? It's just stocks and bonds.
Okay.
So what are your stocks? Your stocks are ownership
of a business,
of a company.
Okay.
So I want to own a piece of Tesla. I will buy Tesla stock, right? That is the stock side, which people say equities as well. That's the vernacular.
So stocks is owning businesses.
Stocks is owning businesses. In the financial markets, you can also be a lender to businesses, or you can be a lender to the government, and you can say, hey, I want to take $10,000 and I'm going to loan that to Tesla, and in exchange, I'm going to get a payment back on my loan, and I'm not going to see any appreciation, and that's your bonds, right? So on the ownership side, if Tesla performs well and grows, you're going to participate in that growth. It will grow with you. On the bond side, you're not going to get exposure to growth because you are just a lender. You give them $10,000, they're paying you interest, and eventually they're giving you your 10 grand back.
Okay, so if we're simplifying, owning stocks is owning businesses in the public market. Bonds is you being the bank or a lender on businesses.
Or the government.
So you get to be the bank or you get to be the owner in the public market.
Correct.
Right? Same thing applies to the private market, right? You can own a business or you can lend to a business.
Correct.
Right? What about index funds?
Index funds are stocks.
So in an index fund, you're owning multiple businesses.
Correct.
So you can still be an owner. It's just going to be spread out versus a single owner in a single business.
Correct. So the question now becomes, all right, let's just use the $10,000 investor. I've got 10 grand. Should I put it in an index fund that's going to have a piece of 500 companies if I do the S&P 500? Or should I pick 10 companies on my own and do it? I don't know. Whichever one works for you. The index fund is nice because it's one check that goes into one parent company that gets divvied out amongst the 500. If you do it the other way where you're picking the 10, you have to pick the 10.
Right.
So it just depends on what works for you. But before index funds existed, people were picking the, let's say, 10 or 15 companies that they were investing into. I like picking the 10 to 15 companies because I generally like to pick companies that I am a consumer of because I believe in their product. Not to mention the fact that, as you mentioned in the last podcast, the S&P 500 is primarily dominated by, 7 or 8 companies now?
Doing most of the growth, yeah.
So, yes, you have a lot of exposure, but it's heavily weighted on the performance of a handful of firms.
Okay, so am I oversimplifying here? If owning a stock is as simple as owning a business, and investing in a bond is as simple as me lending money to a business, and investing in an index fund is as simple as me investing in multiple businesses at once, why do we have words like hedging and volatility and alpha and beta and derivatives? What is the point of all of that?
I think it's a good question. They are terms that have validity and a true meaning to it, but I do think that there are people that will use those terms to confuse people from what it is that they're doing in order to capture their business.
Okay, so saying something like hedging as opposed to just saying trying to reduce risk.
Yeah, mitigate risk is
Right.
what a hedge is.
So hedge just makes you sound smarter?
Yeah. But it also confuses people, right? Like a lot of people, the whole term I used earlier about equities and fixed income, you cannot imagine how many people don't know that equities means stocks and fixed income means bonds. And I fell victim to this too as a financial advisor. I just got so ingrained with these terms. I knew what it meant. And I would talk to some of my clients, and I was making this mistake. And I felt like I would see deer in the headlights from them. Like, are you tracking what I'm saying? I'd be like, no. And they did feel bad saying no because they felt like they should understand it. And so I think people inside of the industry do need to have a greater responsibility to be able to articulate things to the people that they're talking to in a way that they'll actually understand it, not the way that they understand, not the way that I would understand it.
Yeah, so maybe the more fair way to say it is, and I'm not saying this is true or not, maybe we could flush this out, but maybe people aren't talking that way on purpose so that you pay them to do a job for you. Maybe there's actually an incentive for, let's say, a financial advisor or a money manager to speak with more complex terms because it makes you sound smarter, and you're insecure maybe to the idea that if I'm talking too basic, people aren't going to think I'm smart, and then they're not going to want to work with me. Maybe that's actually creates the same outcome. Like for example,
I'm sure that that's the case, but I don't personally agree with that being the case.
Well, I agree with you, but even as I'm
Or
thinking,
at least I don't like it.
Fair. But even as I'm thinking about this, I think I fell victim to that as well, where when I was a skater, I had somebody that just dumbed down everything for me because I wanted to understand it, and he was wise enough to go, if you're going to understand it, I need to speak to you in a way in which you'll retain it. And I did. And then fast forward 15 years later, and we started an investment firm, and I feel the pressure of if I'm talking too basic and people already think I'm just some skater that shouldn't even be here, well, does that kill my opportunity to do something here? Do I need to elevate myself and dress nicer and speak like everyone around me so that people could take me serious and actually have a shot at building a business? I fell victim to that 100%.
And do you think that that's what was necessary in order for you to be successful?
See, that's the hard part. I don't know, because I definitely got to a point where I went, I don't like this. And then I started talking more normal and I got more comfortable with who I was. But that came after we had some assets. So I'm not sure. What do you think?
Well, what actually happened to me as a financial advisor was when I started realizing that I was doing the same thing of speaking in terms of jargon and internal business terminology and not in a way that the clients were understanding, I didn't see a lot of growth in my actual business. And then I started, I don't want to say the term dumbing down because I feel like that's an inaccurate way to say it, simplifying.
Simplifying, 100%.
Simplifying, speaking to the people that I was interacting with in a way that they would understand, not being as involved as I am in this space, right? When I started doing that, the people that I was talking to were signing with me, and they were referring a lot of people to me because they ended up coming back and saying, I finally felt like I understood what it is that you're doing on my behalf. And up until this point, I was completely confused with all the other advisors that I interacted with. I couldn't track, and I felt too stupid to ask questions because I didn't want to come off like I didn't know what they were talking about. And so we, as the advisors of the world, and us as real estate investors who raise capital and talk to investors that want to participate, we have a responsibility to actually speak to people in a way that they understand, not in a way that we know it to be.
Right. Yeah. Yeah, that's right. And I don't know who needs to hear this, but if you're anything like me, you probably should listen. You need to be comfortable with who you are. And that was hard for me because I didn't go down the normal path, right? I didn't go to an Ivy League school. I didn't build my relationships up. I didn't take the path that most fund managers take. And even to this day, I am looked at as an outcast. I'm an outsider to them. And I even have friends that have made an astronomical amount of money. They won't work with me. I'm too different than them. And I think I had to get comfortable with that and kind of come to the realization that my path wasn't yours, and that's okay. And I don't need acceptance by you. I'm not doing what you're doing. And the quicker you can come to that realization, I think the more you're going to benefit in the business that you're doing. But that's not an easy pill to swallow.
Well, I guess the question is, which one would you rather be? Would you rather be the guy that asks the question in the face of possibly looking stupid, even though that's not the case, but you feel like that might be the case? Or do you want to be the guy who just nods his head, says yes, even though you're being told something that you don't understand, and risk your money in doing something that you don't understand?
Yeah.
Which you got to pick which one of those two. Personally, I'd rather ask the question in the face of looking stupid. And I do it all the time when the four of us as partners get together. Jerry, who we often say is kind of the brain, he will oftentimes, especially with lending and debt, speak in terms, and I'm having to ask him a lot of questions because his level of understanding is so much more in depth than mine is. But I need to know what we're doing. So I'm asking the questions, even if it makes me look dumb asking it.
Yeah, and I think that, like, for me personally, that came with age. Like in the beginning, I think we all naturally want to be accepted, or at least me. Like, I want to be accepted. I wanted people to like, hey, I like this guy. Oh, this guy's actually pretty smart. And so because of that, I think I gave in a lot of instances where I shouldn't have, where I should have just been like, dude, I have no clue what you're talking about, or this is what I am. Take it or leave it. That came later on in life for me.
Yeah, but if you're younger, and this is a good, I hope people listen to this one as a tip because it's good. You like how I preface that?
It's good.
If you don't know and you're in a room with somebody and you're trying to impress, if you ask the question and after, let's say the interaction is done, if it's in a group setting, hypothetically speaking, you go up to that person and say, hey, I'm sorry if I asked a question that was overly simplistic, but I so appreciate you spending the time explaining it to me. That person will now remember you versus not remembering all the other people that were at the table.
Yeah, that's good.
So you can use asking questions as the ability to separate yourself from the group if you're trying to network or establish yourself, especially if you're young and you want to just kind of like blend it. Don't blend in. Find a way to stand out.
Okay, so what investment concepts do you think actually matter, and which ones can you just ignore?
We're talking about for the average kind of retail investor
Yeah, like our audience.
that does it on their own?
Well, whether our audience does it alone or has a financial advisor, what do you think are the things that they actually need to know, and what are the things they can ignore? Like, we originally started talking about something like options, right? Or betting on the market, or leverage, or puts. If we were really trying to simplify here, what are the important things to know, and what can they just ignore?
Okay, so I think the most important thing to know is asset allocation, which means the money you have available, where are you putting that money? How much of it are you keeping in cash? And then the next one is how much of it are you putting in stocks, where you're owning a piece of a company? How much of it are you putting in bonds, where you're a lender to a company or the government? And how much of it are you putting in, quote unquote, alternatives, right? So like real estate or private credit, right? So you kind of have like this
Your
systematic,
buckets.
Correct. Now, the reason why you want to know and understand where the money goes within those buckets is because there's something in investing, there's a concept of liquidity, which effectively means how quickly can you convert the investment into cash if you needed to. So as an example, let's say that I've got 100 grand and I plan on buying a house. I'm not going to take my 100 grand and invest it in a private real estate deal that's going to be locked up for maybe 5 years or longer if the deal can't be sold 5 years from now, because that contradicts and conflicts with my goal of wanting to buy a house. So if I'm looking at buying a house in the next year or two, I'm probably keeping that money in cash. The reason why I'm not even putting it in stocks, because a lot of people will say, well, dude, you should put it in stocks because you can convert that to cash very quickly. Well, what if the stock goes down? And I don't want to sell at a loss. Well, now I got to ride the wave until it rebounds. So yes, it's more liquid, but you cannot allow yourself to risk the situation where you need to outweigh a correction, or wait out a correction rather. So you need to know what the buckets are and what the conversion to cash or the liquidity variable is on each one of those buckets. So stocks and bonds can be converted to cash quickly. Real estate takes a lot longer. And so once you understand that, now you say, okay, now what are my goals? I have this 100 grand that is long term, not doing anything with it for a really long time. I have no major intent for that money anytime in the near future. Well, if that's the case, you can allocate to things that have a longer hold period and less liquidity. So that's what I would start with first. Understand what asset allocation looks like, and the robo-advisors are really good at this.
Okay, so if I heard this right, the part of investing that you have to know is, number one, if it doesn't change your long-term outcome, don't worry about it. Is that fair?
Mm-hmm.
Okay. Number two, focus on the variables you can control. Don't spend time worrying about the things you can't. Know what allocation you're going to have, or different buckets you're going to have for your investments: stocks, bonds, real estate, and the ease that you can move out of those investments into cash in case you have to.
Or if you plan on doing something with the money before you even make the investment.
Okay. And then probably one of the most important is that most financial commentary is entertainment. It's not instruction.
Yeah. Now, if you can't do it on your own, that's where you need to get a financial advisor. Like, there's a lot of, you got ChatGPT, you got a lot of AI tools that are out there that you can prompt questions that will give you the responses. And I think some of them will even give you an asset allocation, especially the robo-advisors. If you're still confused, though, go find a financial advisor. There are so many of them out there that will take you on, even if you don't have a lot to invest with, and they will give you guidance. And if you work for a company like that Amazon employee that asked the question, Amazon will have consultants as part of the company that will give you this guidance.
If you're looking for a financial advisor, what are some signs of a good financial advisor?
Ooh.
Good question.
Oh, I know my answer. That's good.
Okay, what's your answer?
Okay, if you're looking for a financial advisor, you have to understand that not all financial advisors are the same. That's the first part, right? If a financial advisor is just managing your investments in stocks and bonds, that's all they're doing, right? There's other financial advisors that do financial planning. They help you plan for the future. They'll bring things like tax strategy in, estate planning. So know that that's a difference. And then the last component is, does your financial advisor do things outside of the market? Private investments, alternatives. And I would say the financial advisor that I want, I like the planning side personally. Like I do enjoy having a team help me on the planning. That seems to be more valuable for me than how my money's invested in the market. Number two, I benefited from a financial advisor that had opportunity outside of the stock market. For me personally, I got to a point where I didn't love the stock market and I wanted more than just that. And that was at a time where you didn't have offerings online or marketplaces or the Omni fund. I didn't have that. And so that was valuable for me. The tax planning is huge for me now. Like, you know my game. If there's incentive out there and the government's telling me to put investments in a certain area so I get to keep more of my money, I want to take that. I want to participate. Estate planning. I have kids now. Like, I want to make sure that my investments are going to be there for them and I don't have to worry about things like the courts in case anything happens. So I like the full package, but there are people that separate that out and they'll go, I'm going to use you for stocks and bonds. These guys are going to be my alts. This is my tax strategist. I don't think there's a right or wrong there. Anything I said you disagree with?
No, but I will restate it so that I think more people will track with it.
Okay.
You should look at a good financial advisor as like a primary doctor. They understand a little bit of everything, but they're not the expert in that thing necessarily, right? So like your financial advisor and the doctor comparison, let's say that like you break a bone. You ultimately will need to go to an orthopedist, but you might go to your primary doctor first, and then they'll assess what's going on and say, okay, you got to go to this orthopedist, or if you need to go to a cardiologist or whatever, all the specialists, your primary doctor has a baseline knowledge of what they all do, but will still send you to the experts to get it done. Now, in the financial advisor world, a good financial advisor will just look at your investments as one piece of the pie. But they will bring into the equation estate planning, like you talked about, retirement planning, insurance. Are you overinsured? Are you underinsured? They will bring in tax strategy. They will look at everything that touches your life that has dollar signs around it. That's kind of like the best way to say it. And they will act as your quarterback to work with your CPA, to work with your attorney, to work with whatever the experts are, to make sure that what the CPA is doing and what the attorney is doing aren't in conflict with one another. Because the financial advisor has enough of an understanding of what they're both doing to make sure, yes, what you're doing on the tax side works with what we're having the attorney do on the legal side.
Okay.
So the financial advisor, a good one, is not just looking at, to your point, stocks and bonds. Now, you might be someone that says, well, that's cool, but I don't have a family yet. I'm not married. I don't have that much money, and I don't really need all those things. That's okay. You can still go to an advisor that will do those things, that you ultimately will get there with them, but you won't start that way with them. So you might just start with them on the investment side of things. And then as you start to make more money, as maybe you get married and now you need an estate plan, as you get a little bit older and now you're starting to build wealth and create assets for yourself, now all of a sudden they'll introduce those things. So a good financial advisor will look at you and say, hey, look, to manage your investments, the charge for that is, typically a percentage of the assets that they manage, right? To do these other things, we'll charge you a flat fee for per year. Well, if you don't need those things, they're just not going to charge you the fee, but you still should go to the person that can do those things even if you don't need them today.
Okay, so
don't think that you're not qualified to go to that person.
Okay, so out of all the financial advisors out there, what do you think the percentage of advisors that are actually good?
Boy, that's a tough question.
It's a tough question because you know the answer and you don't feel comfortable
I know,
saying it,
I'm
or you actually don't know
so
what's
gonna
what.
get smoked by the financial advisors. I'd say about 3%.
Oh, damn. 3?
I think so.
3?
Yeah.
3%.
I'd say 3.
Oh, okay. Now I know why you were scared to say that.
Yeah.
That's insane if that's accurate.
Because
3%?
I know a lot of them that I don't think they do a good job. Well, I'm including all the insurance bros that call themselves financial advisors.
My bros, I love you guys. I know we were catching smoke. All right.
I'm including like all the people that aren't true financial advisors that are. For me, you need a CFP. Those credentials mean that they've gone through an education process on the estate, the insurance, all those things. Somebody who's just a financial advisor can call themselves a financial advisor if they're insurance licensed. They can call themselves a financial advisor if they have a Series 6 or 7 license. So there's a lot of ways that you can theoretically call yourself, quote unquote, an advisor. To me, a true advisor is a CFP. Now, there's a lot of CFPs that aren't good either.
Okay, so then let's...
So just because they have a CFP doesn't mean it's the right way to go.
Woo! Okay. Out of the CFP bucket...
Why do I feel like I'm being set up?
Right? Out of the CFP bucket, what do you think the percentage of CFPs are doing a good job?
Half.
Okay.
Yeah.
All right. That's what I thought you were going to say for the overall bucket.
But again, it comes down to you. Listen, this is your money.
Stand on it, bro.
This is your money.
All right.
This is your life. It is your responsibility to interview and to vet the person that you're talking to. You don't just go to somebody because somebody said, oh, this guy's really good, or they picked a stock for me that went through the roof. You go to that person, you interview them. What is it that you're going to do for me? How is it going to work? How often are we going to meet? Are you just going to make decisions on my behalf, or are you going to walk me through them? I need more guidance from you in the beginning because I really don't know what I'm doing. Whatever position you're in and whatever your needs are, do not shy away from making that very clear to a financial advisor. And if they look at you and say, sorry, dude, I'm not the right guy for you, great. Or if you feel like they are selling you and they're not truly authentic in how they're going to advise and consult you, then you walk away and you go to the next one. But this is your money. You have an obligation to yourself and to your family to make sure that you're hiring the right person. And if you hire somebody and it's not working out the way you thought, that you can actually fire them and move on to the next one, that you don't stay with them because of out of some feeling of loyalty that you don't need. Your financial advisor, who is my old business partner, what made him so good is that he wasn't just investing on your behalf, he was guiding and coaching you along the way. He acted both as your financial advisor and as your educator in so many ways. And so as you got older, you had a greater understanding, and a lot of where you are today is because of the foundational work that he did for you. Imagine if he didn't do that. If all he did was say, hey, look, Mikey, you go skateboard, make your money, and I'll just take care of everything else. A lot of people are like, all right, cool. But you didn't want that. You wanted to be educated, and you found the guy that would do that for you. And that's why that worked.
Okay, so how do you know that you're not getting ripped off by a financial advisor? What are the right questions you should be asking to know if what you're paying them is worth it?
Well, first of all, the first thing you should do is meet with a number of them before you make a decision, because then you'll be able to compare. Secondly, there are advisors that are going to be fee only, where they will only charge you for the assets that they're managing.
Do you think that's better or worse or indifferent?
I think that's better in some ways and worse in other ways, because the good thing about that is that the fee that they charge you is tied to the assets that they're managing for you, right? As your assets grow, their fee grows along with it, right? So you're going to feel this, right? If you're, coming to an advisor with $10,000, well, they're making $100 on your money if they're charging 1%. Well, your $10,000, now you become a millionaire, God willing, right? Because you made a lot of strategic investments, plus you went out and worked, and now you added more money to your investments. Now you're a millionaire. Well, now he's charging you $10,000 a year. It's a lot more than $100 a year.
Yeah,
right?
But if the growth is happening, you're looking at the net, and it's worth it.
You are looking at the net. Most people are not looking at the net, right? You say, if I'm going to make more money, I'm willing to pay more of a fee because I net more, and that's the right way to think about it. There's a lot of people that are going to say, shoot, I used to pay this guy $100, and he's basically doing the same thing for me now that he was doing then, and now I'm paying him $10,000 a year. This is not worth it. So I'm not saying that that's a bad thing. I'm saying that that's how the assets under management fee-based advisor operates. So you need to know what you're getting into. Then you have the advisors that are commission-based, that they get a commission for putting you in a certain product. So like a lot of the insurance bros fall into this category, right? Their recommendation to you, while it should be what's in your best interest, might not necessarily be. It might be in the best interest of the compensation that they're going to get. I don't like that, right? Because I have incentive to put you in something that's not best for you, but it's arguably better for me. You hope that that's not the case. Let's be honest, it absolutely is the case. So I generally stay away from that. And then you have the ones that are doing both, which there's a lot of them that do both. They're a broker-dealer, meaning they're getting a commission for what they're putting you into, plus they're fee-based. Those are dwindling away because it's getting more regulated, but those are the ones that I would also stay away from.
Okay.
So out of those three, I go fee-based.
Okay. And what about real estate? Do the same principles hold true? That there's going to be a small percentage of them that are going to learn it, be active, it's complex, go do it yourself, and then the others should be finding somebody to help them? Do you view it the same way?
I think unless you are willing to put in the time and the education to be active in any of the private markets, you should be passive, 100%.
Okay, so
I wouldn't do it unless you're willing to do it full time.
Okay, so on the real estate side or the private equity side or the venture side, just look at it as this very simple binary. If you're willing to sacrifice your time, okay, you're active. If you're not willing to sacrifice your time, stay passive.
Yeah, and bringing that back to the financial advisor, you touched on this earlier, I would only go with a financial advisor that invested my money beyond the stock market and the bond market.
Yeah, that's how I am too. Yeah. That was huge for me.
And I hope that more financial advisors are starting to come around to that. I mean, we work with a lot of them, but there's a lot of them that are very uncomfortable with it because they themselves don't understand like the private markets. I don't think that those financial advisors are going to be in business much longer as technology continues to get better and people are going to just go the DIY route. So if you're an advisor and you actually want to separate yourself from the herd, you need to offer alternatives, in my opinion, and you need to be an advisor that goes beyond just managing money. You got to be able to do the estate planning, tax planning, all that stuff.
Okay, so if you're an advisor watching this and you made it through the first part and Michael basically telling you that you are not hitting the bar. No, I'm just joking. But for advisors that are watching this, if you're not offering it and you want to, because you are seeing that trend. I'm starting to talk to a lot of advisors that are saying, I'm getting pressure from my clients. I want stuff like real estate. I want stuff like private equity. I want venture. And the advisor's going, okay, great. I don't know it. I don't know what to do there. What's your recommendation to them? They understand that that's where it's going. They're stuck.
For the advisor?
Yeah.
Well, it's your job to learn it.
Oh.
If you want to keep those clients, you're going to have to actually go out there and learn enough so that you can quarterback it. Like, a financial advisor is not an attorney. You don't expect a financial advisor to draw up a trust, a will, a durable power of attorney, healthcare directives, right? The attorney does that stuff. But you, as the financial advisor, know that those are things that need to be done on behalf of your client. Same concept here. You don't need to do the real estate, but you need a baseline knowledge of real estate so that you can advocate for it on behalf of your client. And the good thing for us is, plugging commune here, we've got basically a pretty robust program for the financial advisors that work with us, that we educate them along the way so that they can feel comfortable in recommending real estate to their clients.
Okay, so you're saying that basically they're already doing this. They just haven't brought in the experts, like when you gave the doctor analogy. They just haven't brought in the experts into the fold to offer things like real estate, private equity, private credit, et cetera. All right, so go do that. Right?
That's what I would do.
All right, go do that, gang. All right, let's finish it on this.
Hey, real quick, what is one thing that you should do even before you get a financial advisor? Think of us 7 years ago.
The boys.
Ooh, the boys.
The boys 7 years ago.
7 years ago.
To give you context, the boys, Mike, when I had lunch with him to try to have him come help us with commune, he said, hey, cool, man, I don't know anything about this. I don't know real estate. I don't really know about investing. This is not my wheelhouse. And now he's the guy, and Ryan, they're the guys that all their friends hit up and go, hey, what should I do?
Do they hit you guys up?
Oh, yeah.
I love that.
So 7 years ago, the boys, what are you telling them? Stop buying Blue Bottle. You told them that this morning.
I'm telling them to find content that's free online that is not chasing trends. If it's boring, I would say it's probably accurate, right? So,
Well, just chat your way through this.
ChatGPT is a great way to do it too. Or you probably have somebody in your network, whether it's friends or families, that are in the business.
So
I
you're
would go to
saying
them.
so you're saying you have to start by learning a little bit.
Yeah, you need you no matter if you know nothing or if you know a ton, there's value in learning more, even if you're working with a professional. Because if you're just giving everything to your professional blindly and you're not asking questions, then you're not doing your end of the job here, right? Like, you got to learn.
Okay, so watch this, Mike. What was something that you took 7 years ago that you applied and are now doing today?
He opened an IRA.
Opened IRA and starting. Putting $25 that I could lose every week and it not being the end of the world.
Right. So, like, dollar cost averaging, that's what he did, right? Fancy term. Jargon in the financial advisor language. What the hell does that mean for the average person?
Okay, so don't
Right. So
worry.
if you don't have an education in investment, you're saying dollar cost. I have no idea what that means. It means what Mike just said. He took $25 every week instead of buying 3 cups of coffee at Blue Bottle and put it into his IRA and then systematically let that money go in every single week. And while it may seem inconsequential, 7 years down the road, you look back and you're like, holy crap. I put in $25 a week, plus I got the growth of those investments. I have a lot more money than I thought I would at this point in time. So that is an unbelievably powerful strategy because, not to get too technical on dollar cost averaging, but when you systematically invest every single period over years, you're investing when the prices are low, you're investing when the prices are high, and you're basically playing the average. But you are creating a discipline that will compound over time, and you should see results from that.
Okay, so what you're saying is if I'm sticking to my strategy and I'm buying $100 worth of Bitcoin every week, and 2 months ago I'm buying at $100,000 a coin, and then this week the market gets hosed and $1 trillion gets wiped, you're telling me I'm still investing $100 today at $70,000 a coin?
No, because I wouldn't have you buy $100 of Bitcoin every week to start with.
Damn. All right.
I would tell you to buy $100 worth of $100 worth of like some sort of an index. Maybe it's a Bitcoin index, a digital coin index offset with a traditional stock index. Take that $100, create an allocation, and then let the $100 get spread over that allocation. Right?
Okay, well then let's.
So in a hypothetical,
Okay,
I would do.
you're not buying the dip right
If
now.
I was Mike 7 years ago,
That's what I'm hearing. You're not buying the Bitcoin dip right now.
I'm not saying that, but you started off by $100 every week in Bitcoin.
I'm just saying.
You specified one company and 100% of your money going to that one company.
I'm just saying,
What did I give as the example about Facebook 20 minutes ago?
I bought this morning. I'm sorry.
Huh?
I bought this morning.
But you're not talking about somebody who's starting.
Okay.
Okay, wait a second. You bought $100 of Bitcoin today?
No, I bought Bitcoin today.
Okay, how much did you buy?
$500.
Okay, did you buy $500 of Bitcoin last week?
No.
Did you buy $500 of Bitcoin the week before?
I bought the month before.
Okay, did you buy the
I'm
month
not buying
before-
weekly.
Did you buy the month before that?
I can't remember.
Okay, so right off the bat, your discipline is off. So like blackjack is a really good example. They tell you when you learn how to play blackjack, whatever system you adopt, don't deviate from that system. Meaning, if you're gonna bet or hit on the dealer showing a 5, you do it no matter what. If you're gonna dollar cost average. Don't do it when it's convenient for you.
Yeah, you're gonna
because now
learn.
you're trying to time the market.
Yeah, 100%.
Okay, so-
Listen, my Bitcoin or my crypto strategy is so out of line with everything else.
Because you see it as gambling.
100%.
Okay.
Yeah. So.
But Mike was not gambling 7 years ago.
That's true.
So let's watch out for our boy.
That's right.
And people like him and
That's
give them
right.
decent advice.
That's
and
right.
this is not investment advice. This is just life advice, right?
Yeah, because I sold at 100 and then I copped at 70. There was a dip, maybe a 78,
God
80.
bless you.
I can't remember.
If you have
But
the
my
100
Bitcoin money, bro, just so everybody knows, I could get wiped today. It is like just fun for me. Man.
Must be nice.
No, it could be nice for everyone because I don't have hundreds of thousands or millions invested in Bitcoin. I
Okay.
invest a percentage that I'm totally comfortable
So let's
losing.
take Mike's $100 as an example every month. $100 every month, because he's doing $25 a week, would go into his investment, right? If I was Mike, I would say, okay, out of that $100, because he's young, I would say probably 50 to 60% I would put in a handful of stocks based on companies I liked, or in a mutual fund that was growth oriented, that was stock oriented, or in the S&P 500 index, right? Any one of those, basically 50 to 60% stocks. I'd probably do like 10 to 20% in bonds,
Dang, really?
right? Small, very small allocation. You don't have to. I'm just saying that I would, right? And so now we're calling it like 80%. And then the last 20%,
Crypto.
sure. But not a single coin like Bitcoin. I would be on the index of the digital currency space. Well, yeah, you're going to look at the price now and say, oh, how much am I up? Yeah, that doesn't
All right,
matter.
kid.
That's irrelevant.
No, that's not what I'm saying. That's not what I'm
Because
saying.
now Mike's getting stocks, he's getting a little bit of bonds, and he's playing a little bit of a gambling game with the digital currency or the coins.
Gang, Bitcoin down. It's 66,000. Woo! XRP, one of my favorites. They're all down. Woo! Sounds like a buy time for me.
Well, how many people when did Bitcoin peak at 130,000 a coin?
I can't remember.
How many people?
No, did it go that high?
I don't know.
I thought it was 108. I got it in my head.
Call it when it was 95.
Right.
How many people were swarming to try to buy Bitcoin? Everybody.
You think so?
Well, of course, it was the hype. It's going to go to $1 million. All the pundits were talking, well, not all the pundits, but like all the blockchain digital pundits were talking about it. You got to get in it. You're missing out. You're missing out. You're missing out. You're missing out. They were playing into everybody's feeling of greed, right? And if you don't participate, you are going to miss out on making a killing with your money. All those people now that you said Bitcoin's at 66, are they saying the same thing now?
I hope they're not selling, but listen,
Forget not selling. Are they buying?
Well, hey, hang on though. With Bitcoin, you can sell. You can realize the loss and then buy right back in.
Okay. Are they doing it?
I don't know. Are you saying do it?
No, I'm saying that when prices are low, are you buying versus when prices are high, are you selling?
Listen, I hear you. I just started this thing up by saying I'm buying, and you pressed me, dog.
I didn't press you. I just said you don't have a discipline of investing systematically over a period of time.
In Bitcoin, that's true. Totally true. I'll own that. I'll totally own that. All right, you guys heard it here first. The advisors are hopefully on the right track and they're going to start doing more than just stocks and bonds. You now have the right questions to ask them so that you know that the fee you're paying is worth it. Don't worry about the jargon like derivatives and alpha and puts and options, and just get started, even if it's $25 a week.
Get started, no matter what. Get started. Don't delay it. You have no idea how powerful $10 a week can be for you long term.
Michael, you want to close this thing?
Just for Austin, Bitcoin is 123.